Welcome to Study Loop.
Hey everyone, today we're solving problem number 4 from chapter 17, Financial Markets of the textbook, which asks which has a higher average return over time, stocks, bonds, or a savings account? And it also asks us to explain our answer. So over a sustained period of time, stocks will have a higher average return than bonds, and bonds will have an average return higher than a savings account. So based off of that much we know, and also based off of this table right here, we know, actually I should be doing this in black, sorry about that. This is a table from chapter 17, and we look at our return column. For stocks, the return is very high, and thus stocks will end up winning out. I will explain briefly down here in a second, but the answer here is going to be stocks. That would be number 1, and then number 2 would be bonds, and then number 3 would be the savings account. As we can see also, the return on a savings account is low, and then for bonds it's medium. So this table will, from chapter 17 of your reading, will give you the answer as well. So why is it that stocks have the highest rate of return over sustained time? Well, the rationale is that stock values can grow or decline by a very large amount. So they can grow or decline by large amounts. And I'll give you a few examples. I think examining depressions and economic booms are kind of the best ways to see how these three really fluctuate. I'll just say they grow and decline a lot, by a lot, rather, or largely is better. And I'll list an example. For example, as we were coming out of the recession from 2007 to 2008, the S&P 500 increased 26% in 2009 after declining 37% in 2008. So down 37% in 08. That's probably one of the best examples. In 2008. And then after it went down a lot, it went back up a lot. So it grows and declines by large amounts. It went up 26% in 2009. So that's just one example of how stocks really change their value. And the return is high. So stocks are number 1. Now bonds are kind of just in the middle. It largely depends on interest rate fluctuations. So they vary far less because the interest rate can only change so much. I'll abbreviate interest rate as IR. Less change than stocks. But they're going to change more than a savings account. And I'll explain why in just a minute when I go to savings accounts. Less change than a stock. Because the interest rate can only change so much, but it does change something. And stocks. Good, so we know that much. And finally, to explain why the savings account has the least, highest, or the lowest rather, average return over time. So a savings account in any given year changes very little. It's one of those assets that just doesn't change that much. That's probably the best explanation. Um, it is a little repetitive, but very little change. Yeah, so essentially stocks have the highest average rate of return over time, then bonds, then savings accounts. And there you have it. If you guys enjoyed my video explanation of this problem, please hit the like button next to it. I hope you all have a nice day, and thank you for watching.